This is AHA Business Radio, creating aha moments for business, by business, and about business, providing opportunities to discover information to help you run your business and guide your decision making. The more you know, the better decisions you make. AHA Business Radio is produced by Allan Hirsh Advisors. For more information, log on to ahabusinessradio.com. To join in tonight's conversation, call 410-481-1300. Now, here's your host for AHA Business Radio, Allan Hirsh.
Welcome to tonight's show. My guest this evening is Troy Brewer from the Brewer Investment Group at the Wells Fargo Advisors. Welcome to the show, Troy. I appreciate you being here this evening.
Thank you, Allan. Good to be here.
The first question I ask every guest, what motivates you to get up in the morning and go to work?
Allan, what's not to like? I get up in the morning. I get to go to the office, read the Wall Street Journal, read different research reports, check different websites, have a cup of coffee, and prepare for the day. And in my world, that's a fantastic way to start the day. So getting prepped to answer questions and help people, review portfolios, it's just a good time. I enjoy it.
That's great. So how did you get started in becoming a wealth manager, investment advisor?
Mm-hmm. Once upon a time, I thought I wanted to be an engineer, manufacturing engineer. Way back in the late 70s and early 80s, I went to Maryland, down at College Park, focused on the industrial technology program, and came out of that program as a manufacturing engineer for Westinghouse. I enjoyed that position, worked my way through the ranks. They were kind enough to put me through graduate school at Loyola College and helped me achieve an MBA in finance. And going through the early years at Westinghouse, 401ks were just coming out, and they were interesting. They were a new way of investing, preparing for retirement, and I got involved with that quite a bit. So that helped spark my interest in the investing world, looking at different options, looking at mutual funds, and coupling that with an MBA in finance from Loyola College, it was clear to me that, hey, I wanted to move from the technical world of manufacturing, engineering, into the technical world of finance. And my wife, Carol, was the one who one day told me, she said, hey, you're miserable in doing what you're doing right now. I know you want to get into finance. Go. So I moved on and started with Lake Mason in 1993 and never looked back.
Well, that's great. So how long have you been with Wells Fargo Advisors?
Wells Fargo, about six and a half years. Mm-hmm.
Okay. So one of the questions that sometimes people ask me, and I don't have the answer because I've never been in your kind of business, what should someone listening who's looking for a wealth manager, a financial advisor, be looking for? What kinds of questions should they be asking so that they can find out the person that they might want to work with?
Mm-hmm. I think that it's really a conversation they have to start with. When I bring someone to the office to talk to them, to potentially become a new client, it's not a done deal from the beginning. I like to call it a fit meeting, where the client will come in, I'll tell them about myself, I'll tell them what I do for clients, I tell them what I charge my clients, and have a general conversation just to get them to know me a little bit, to see if they're comfortable, to see if they mesh with me. And I'm looking for the same thing. I want a client that I can get along with comfortably. I can guide and have them accept my guidance. It's going to be a long-term working relationship, and we want to make sure that both sides are comfortable. And if so, then we proceed to meeting number 2 or 3 and get things
So
going.
the one thing that I'm hearing from there is that you feel that you have to build some kind of a trusting relationship.
Absolutely.
On both sides, that you have to be able to trust the people you're working with, and they certainly need to trust you.
Absolutely. That's probably the key thing, is trust, the belief in that I'm doing the best thing for my clients and putting them in the right investments, the right position. Trust is everything. Other than that, background's important. You got to have a good firm behind you or a good knowledge base to do the right things as well. But I think trust is a key component. Many of my clients come from referrals from existing clients. They trust those friends of theirs, their family members. There's a link between those family members that refer them to me, and it creates a nice circle so that if there's ever an issue, that can be easily resolved. But there tends not to be an issue because everyone's on good behavior. Everyone knows that, hey, we're all linked in some way through relationships, whether it's friendships or family or something like that. And we all play nice.
Okay. So if I'm coming to you for the first time, we're trying to get to know each other, what kinds of questions should I be asking besides just to get to know you and trust you that a good wealth manager should be able to answer for me?
Mm-hmm. They might want to ask about the portfolios that I use, the different types of investments that I might suggest for a client. They might want to know about my retirement planning software, the programs that I put together. How deep are those programs? How far into a relationship do they go? They may also want to know what I do beyond that. The three components that I work with on my clients focus on management of the assets, retirement planning, and also working with their CPAs or accountants as well as their attorney in creating a sound estate plan. So there's three different components that I work on. But when a client comes in to talk to me, they should ask questions about me personally, what I'm all about, but they may also want to know about the firm and the different services that I provide.
Okay.
I'm not a stock jock. I'm not going to be calling them every day and giving them the stock tip of the day, things of that nature. But they probe, they look for different things that are important to them. I'm doing the same thing as well. And if it's a match, great. If not, then we just part ways.
Okay. Before we go to the next question, just to remind everybody, I'm Allan Hirsh, and I'm talking to Troy Brewer of the Brewer Investment Group of Wells Fargo Advisors. So besides getting to know them, what are some of the things you want to know or a wealth manager should be asking the client so that they can feel that there's that the trust is being built between you and the prospective client?
I want to know what they expect. I want to know how involved they want to be in the relationship or in the management of their whole financial area. I want to know what goals they have, what fears they have, what they've done in the past. If they've had an advisor before, I want to know what was good about that, what was bad about that. And if they have an advisor or had an advisor, why are they talking to me? What made that relationship go sour? So I really want to get a good feel for what they're looking for, and hopefully that matches up to what I offer.
Okay. One of the things when we first met, you talk about, and it's now going beyond just that introductory part of the practice, one of the things you talk a lot about is the cost of investing. And I don't hear that from a lot of people that I run into that are in the investment business. So could you explain to the listening audience what you mean, what the real costs of investing are, and why it's really important for the investor to understand it?
Mm-hmm. Certainly. And the example that I'll give you is a fee-based advisor, let's say myself, working with a client. I'm going to charge. I'm sorry.
There are several ways you can charge clients as an investment manager.
That's true. There is a commission-based relationship where every transaction, every product that a advisor offers to the client, there's some type of commission associated with that. There may be a commission to get into the investment. There may be a commission to get out of the investment. There may be some type of trail or stream of money that's paid to the advisor as long as the client has that investment. So that's typically a commission-based relationship. A fee-based relationship is one where a fee is paid to the advisor. It's typically a percentage of the assets under management. So a typical fee may be anywhere from 1 to 1.5% on the total bundle of assets that an advisor is managing for someone.
So in that particular case, well, in the two cases, and then we'll go to first break, as I understand it from that, for those listening out there, In the first case, you're paying every transaction.
Pretty much.
And sometimes ongoing, depending upon what the investment is. And in the other, you're paying based on the asset value. So the investment advisor is in a position, if he performs or she performs, then both you and they benefit because if the assets go up, their fees go up.
Exactly right. So we're both on the same side of the table. If I do a good job, the assets increase in value, the client is happy because of that, and my percentage that I'm charging is going to go up as well. It's a nice relationship between the two.
Okay.
And typically, if I could add this too, the percentage that a fee-based advisor typically charges a client tends to be a little cheaper, at least in my case, a little cheaper than what the old style commission-based relationships used to be. So for turning that relationship into I'll call it a recurring revenue type of relationship, the client is benefiting from lower fees, but I'm benefiting because I have a steady stream of income.
Right. And there's some other things involved in that have caused that transition as well. I need to go to commercial break. As we do, we'll have the traffic update, and when I come back, I will continue the conversation with Troy Brewer of the Brewer Investment Group, Wells Fargo Advisors. Later in the show, I will have the AHA Business Trivia Contest. I'm Allan Hirsh. I'm Allan Hirsh Advisors. And this is AHA Business Radio on CBS Sports Radio 1300 AM.
Now back to AHA Business Radio, creating aha moments for business, by business, and about business. Once again, here's your host, Allan Hirsh.
Welcome back to the show. I'm in the studio with Troy Brewer of the Brewer Investment Group of the Wells Fargo Advisors. If you have any questions or comments, please give us a call at 410-481-1300. So just before we left, we were talking about the general cost of investing, but one of the things I know you really study and work on from our first discussion is what the true cost of investing is. So can you talk about that a little bit? Because from what I understand from you, most consumers really don't know what the real cost of investing and the investment instruments are. Mm-hmm.
Let me back up a second first, though. When I talk about the fee-based advisor, remember that the fee that the advisor is charging the client covers all the commissions. There are no more commissions. All the investments are paid for, or should I say acquired for the client under the umbrella of a fee-based account. The account fees are covered. Anything we do for the client, the planning, the discussion of the client situation with the attorneys or the CPA, everything is covered by that fee. But let me get into the issue of the cost of investments. Many people, if you talk to them and if they're using an advisor, if you ask them, what does your investment account cost you? Many people will quote the fee that they're paying the advisor. So that may be 1.5%, something like that. Many people don't realize that many of the investments that they're using are also costing them money. If you look at a pure bond, there is no internal cost of a pure bond or a pure stock. So if you buy a share of Apple, let's say, there is no ongoing internal fee that is being charged to the client for holding that.
So what you're saying is, and if you buy 100 shares of Apple Computer on a fee-based account, you buy the shares at the market value,
correct,
and that's the only cost for those shares other than the fee that you're paying on a regular basis to the investment advisor.
That's true. That's true. So when you look at mutual funds have internal fees associated with them. They're typically called management fees. So a typical mutual fund might cost 0.75 point to 1 point.
Meaning 0.75% to 1%.
That's correct. There are other investment products that we use called exchange-traded funds, relatively new to the marketplace. I guess they came out in the late 90s or so. I'm not really sure exactly when. But an exchange-traded fund is an index. It's a basket of investments. Sometimes it's a basket of stocks, basket of bonds, basket of whatever. But the ETF typically is
What does ETF stand for? Do you know?
Exchange-traded fund.
Okay, thank you.
But typically the ETF is a very low-costing investment as compared to, let's say, a mutual fund. Now, remember that an exchange-traded fund is not managed, so there's no manager there trying to outperform the index. Therefore, you don't pay for a manager. So a typical exchange-traded fund might cost a person 1/4 of a point, maybe something even less than that. Whereas a mutual fund, as I mentioned, might cost 3/4 of a point up to a point or 1.25 points. Now, I don't have a problem with mutual funds, except that if you have a mutual fund, make sure that the money that you're paying that advisor is money well spent. There's no need to pay a manager of a mutual fund if, in fact, they are always underperforming the index. It doesn't make any sense. So my comment to the investors, and something that I do for my clients all the time, is to often look at the mutual funds that we use. And by the way, we use quite a few mutual funds in the portfolios. But the mutual funds that we use, we typically look at the 5 and the 10, maybe even the 15-year track record to make sure that they are at least worthy of the cost of the manager. So if they're not worthy of the fee that we're paying them, we either pick another mutual fund or, if it's appropriate, we use an ETF in its place. The key I'm getting at is mind the expense of the investments that you have. Many people have portfolios full of mutual funds where many of those mutual funds aren't worthy of the manager that you're paying. So take a look at that.
Just want to remind everybody out there, I'm in the studio with Troy Brewer of the Brewer Investment Group of Wells Fargo Advisors. If you have any questions for Troy or myself, please give us a call at 410-481-1300. And the mutual funds, what I'm hearing, the mutual funds have a management fee that you're paying. It's coming out of the value of the asset value of the shares that you own in that, whereas an ETF, basically you're buying it as if it's a share of Apple.
True, but let's look at a mutual fund, for example. A mutual fund may be achieving an 8% return. Well, the client doesn't get that because that is a gross return, and the mutual fund manager will take a piece of that for their own expenses and possibly pass to the investor something a bit less than the gross number. So let's say that they're making 9% and they pass to the client 8%. They're keeping that 1% for their own expenses. An ETF will do the same thing, except with an ETF that cost tends to be smaller. Also remember that, and I want to make this point too, a mutual fund typically is referred to as actively managed. So you do have a possibility of a good active manager outperforming the sector of the market that mutual fund is focusing on. An ETF is only going to get you, at best, the index that represents that sector. So with an ETF, you're going for the index return. A mutual fund manager, you're hoping to do better than the index.
Okay. So that's one of the ways of understanding the cost associated with investing. So let's look about some of the strategies, and I don't mean, and I'm sure this is the kind of thing you talk about with your prospective clients early on. Do they have a high risk tolerance, low risk tolerance, those kinds of things? So what are the kinds, and I know we can't get into individual investments.
Correct. Although, if I could add something there, we can, but it's very individualized.
Right.
In that, if a person wants to talk about their risk profile or their tolerance for risk, they need to come into my office, sit down with me, describe what they're looking for. I run them through a questionnaire. I'll discuss different things and try to get a real good feel for where they fit. Some people who describe themselves as very conservative, they may turn out to be a moderate type of investor. Some people that claim to be aggressive might turn out to be a conservative person that likes a hot stock every once in a while. So it really takes a conversation to uncover what they're all about. And you can't do that on the air.
No, I'm actually, I understand that. And what I'm looking at is this, we talked about it very briefly on the, prior to the show in the studio, the idea of the long-term horizon. So Why don't you talk, because you mentioned that the returns of the average investor versus the market, and it's quite revealing to me that so many of the average investors aren't getting the true return that if they stay the course. So why don't you explain some of that?
Love to talk about it. One of the key things that I feel all financial advisors do for their clients is to keep them focused on what their goals and objectives are. Too many times we can easily sit down and watch CNBC, Fox News, CNBC, any of the news channels, and get spooked by the stories that they have or the perception as to where the market is going. One thing you always have to understand, no one can predict where the markets are going. Look at the recent election. No one, or very few people, predicted that the election would turn out the way that it did. So my point is, nobody can predict the future. Therefore, pick or choose a sound portfolio, one that you're comfortable with, one that has good investments, one that is not charging you undue expenses, something that's been monitored and checked, and stick with it. Over time, it's interesting. I have a little something that I use with clients all the time, which shows the last 36 years, the markets have ended up 27 times. So 27 out of 36 years, going back to 1980 or so, the markets have performed pretty well. In those 36 years, though, every year there has been some type of downward movement through the market during that 12-month period. The average downturn in the market in any one of those years, if you group all 36 years together, the average downturn during the course of the year is 14.2%. My point is, every year you're going to have something that spooks you and makes you want to leave your investments or just go to cash. You can't do that.
And it's very interesting. For those of you out there, think about that. And when we come back from the break, we'll talk about some of the things I know and certainly Troy knows about why those numbers are very important to us. So when we come back from the commercial break, I will continue the discussion with Troy Brewer of the Brewer Investment Group at Wells Fargo. And later in the show, I have the AHA Business Trivia Contest. I'm Allan Hirsh, and this is AHA Business Radio on CBS Sports Radio, 1300 AM.
Now back to AHA Business Radio, creating aha moments for business, by business, and about business. Once again, here's your host, Allan Hirsh.
Welcome back. I'm in the studio with Troy Brewer of the Brewer Investment Group of Wells Fargo, and we're talking about strategic investing. If you have any questions or comments for Troy or myself, please give us a call at 410-481-1300. When we went to this past break, you were talking about the fact that, if I'm not mistaken, that over the last 37 years, the 27 of them, I think, have been have January 1st, December 3rd, have been up.
That's correct.
Yet each of those years had an average downturn of about 14%. Mm-hmm.
For example, I'll give you a couple of examples. 2015, the markets, if we're looking at the S&P, was down approximately 1% at the end of the year. But during the course of that year, the markets were off 12% at one time. This year, the markets are up nicely so far this year. But there was a point in the market this year where the markets were down 11%. Those drops in the market should either be viewed as par for the course or buying opportunities if you want to do anything at all. What you don't want to do is step out of the market. Here's the problem. If a person sells their investment, they always have to think about when to get back into the market. That's probably as difficult a decision as getting out of the market. I want to parlay that into another bit of information that I have from Wells Fargo advisors, where if I look at the time frame from 1995 to 2014, slightly different time frame, just how this was put together. But from 1995 to 2014, if a person was fully invested in that time frame, their return in the S&P 500 was 9.9%. If they missed the 10 best days, those days where the markets are up 400 points or 600 points or whatever it is, if an investor misses the 10 best days in that 20-year period, suddenly they're down to a 6.1% return. If they miss the 20 best days, they're down at a 3.6% return. And if they miss 30 of the best days, their returns are 1.5%. So you can see that missing those great days, and you can never predict when they're going to happen.
Well,
you're really killing your returns.
Yeah. It's the old story. For most private investors, when the market goes down, they panic and sell.
Right.
And then they're not there when it goes back up again, and they're doing just the reverse of what the theory is: buy low and sell high.
Mm-hmm. I earn my keep when days are rough in the marketplace because clients are calling, talking about their accounts. They want to hear that I'm there, and typically what I'm doing is reviewing the portfolio with them. I'm reviewing their plan, and I'm making them or helping them understand that the investments they have are good. And we don't want to sell out of the portfolio because we don't know what tomorrow or the next day is going to bring.
And over the long period, 100 years, the market's been as performed. Any 15 to 30 year segment within that 100 years, the market's been up. Mm-hmm. And so the point I like to make, and one of the reasons I want to talk about this, most people get out when they shouldn't, get in when they shouldn't.
Mm-hmm. That's very true.
They should stay the course.
Mm-hmm.
Because long term, if you're looking 10 to 15 years, you're going to be better off if you have sound investments and a good manager that's got you in the right kinds of companies or mutual funds or investments. You are going to do far better by staying the course. It reminds me, and it reminds me of a joke my dad used to still does tell about the stock market. The bulls make money. The bears make money, but the pigs lose.
That's very true. Very true.
And it's not, no one's going to predict when to buy low and when to really sell high. Mm-hmm. So the point is, find those investments you want and build from there and stay the course, because long term you're going to win.
Best time to invest when you have money. That's what I always tell my clients. Relating to the average investor, there's another study out there. Many people may have heard about this, but there's a study called the Dalbar study, which always goes back. Every year they go back 20 years and look at the performance of the markets, and they also look at the performance of the average investor. And if you look at the period from 1996 back to 2015, the S&P 500, again, we're looking at slightly different time frames, so these numbers will keep jiggling around. But let's say that the S&P 500 was up 8+% over that 20-year period. Okay, the S&P was up 8+%. Home prices appreciated 3.4%. Gold appreciated over that time frame, an average of 5.2%. The average investor up a whopping 2.1%. Why is that? A lot of people look at that and say, what's going on? Why isn't the average investor making money when the S&P is up 8.2 and everything else is looking pretty good as well? Well, that's because many investors will sell at the wrong time and they'll buy at the wrong time. Look at it this way. If you're looking at your 401k, many people have a 401k, and perhaps you're looking at it too much, and you one day look at your portfolio and you say, wow, fund number A, or let's say fund A, is doing very well, it's up, and fund B is down. I'm going to sell fund B and put all the money in fund A because A looks like it's doing pretty well. Well, they'll do that, only to find out that Fund A starts to turn down and Fund B starts to turn up. They all go through cycles. The markets rotate just like everything else does. The key is pick a diversified portfolio, pick good investments, leave it alone, review it typically once or twice a year just to make sure that things are doing what they're supposed to do. The manager hasn't changed or something hasn't gone awry, but leave the portfolio alone and let it work for you.
And that really is great advice. And the records and the history, no one guarantees the future.
Correct.
But even through the Great Depression and the Great Recession, you take that, you had the Great Recession during the time frame that we've just talked about, 1996 to 2015, we had the Great Recession where the stock prices were down 50% in 2008, 2009, if I'm not mistaken. Mm-hmm. And yet, even through all of that, if you stayed the course, you would have had a total return of, according to that, almost 9%. Mm-hmm.
The market certainly came back, brought all your money back plus some, I'll put it that way. Yeah. I'm looking at the charts here. 2008, the markets finished up, if I'm reading this correct, which I think I am, the markets were down 38% in 2008. People were spooked. I was waking up 2 or 3 times at night worrying about clients, worrying about the markets, worrying about lots of different things. 2009, the markets were up 23%. So for the person who at the end of 2008 said, "Uncle, I'm out. Get rid of all these investments, put me in bonds, put me in CDs." They locked in a low level in their portfolio. 2009, the markets were up 23%. 2010, we're back up 13% again.
Yeah.
So again, you cannot predict the future. Stay with good investments. Make sure you have a handle on the cost of your investments. Review it once or twice a year. Discuss your plans with your advisor. Focus on your estate planning aspects. And keep invested.
Yeah. A couple of things, and I think that's a good advice, and I live by that, and so I really appreciate us talking about that for the listener tonight. I also want to talk about a couple of the we haven't really talked about it. Some of the, not really estate planning, but some of the retirement accounts, the Roth IRA and the regular IRA, what they do, and they can help for investors. And we only have about a minute before we have to go to the next commercial break. Can you very quickly just summarize what they are and what the difference is?
Mm-hmm. A traditional IRA, and by the way, if a person has a 401k, they can still invest in a separate IRA account. A lot of people don't realize that, but you can do both. What you can't do, many times a person may make too much money to invest in a Roth IRA. There are certain thresholds that if a person makes more than a certain amount of money, they cannot invest in a Roth IRA. But the difference between the two, a traditional IRA is I'll use generalities. The money that you put into a traditional IRA is, let's say, maybe pre-tax money if you can deduct it off your taxes, but it grows tax deferred, so that somewhere down the line you're going to pay tax on the growth of that IRA.
Well, when you take the money out, you pay the taxes on it.
Correct. A Roth IRA, as you put money into a Roth IRA and it grows over time, when you take the money out, as long as you've had it invested for 5 years or longer, and there's some other rules that go along with that as well. But typically, with a Roth IRA, when you take the money out of a Roth, there is no tax on the growth.
But you've put it in after you've paid the taxes.
True.
So that's the one you put it in after paying taxes, one before paying taxes. Either way, you're going to pay the taxes.
Right. And there are some nuances there, but let's put it this way.
We'll come back to this when we
go
to break.
After the break.
Right. And when we do come back, I will have the AHA Business Trivia Contest, and we'll continue my discussion with Troy Brewer of the Brewer Investment Group of Wells Fargo Advisors. I'm Allan Hirsh of Allan Hirsh Advisors, and this is AHA Business Radio on CBS Sports Radio, 1300 AM.
Now back to AHA Business Radio, creating aha moments for business, by business, and about business. And now it's time for tonight's AHA Trivia Question, where you can win great prizes from the AHA Business Radio Show. Call 410-481-1300 if you know the answer. And now, with tonight's AHA Trivia Question, here's your host, Allan Hirsh.
Welcome back to the show. Tonight's trivia question, interesting enough, it's what we were actually talking about just before we went to break. When did Congress approve the Roth IRA? If you think you know the answer, please give us a call at 410-481-1300. And the caller with the correct answer will receive a gift certificate to the Fleet Street Kitchen, a member of the Bagby Restaurant Group in downtown Baltimore. Actually, it's an excellent restaurant, and I would recommend it to anybody. So again, the trivia question is, when did Congress approve the Roth IRA? Please give us a call at 410-481-1300 if you think you know the answer. So I'm in the studio with Troy Brewer of the Brewer Investment Group of the Wells Fargo Advisors. And we were actually talking about the difference, and we got a little into it because of the nuances during the break between a traditional IRA and a Roth IRA. But they are, either way, they are tremendous opportunities for long-term growth and self-retirement programming. Am I correct?
I agree. Just to clear this up real quick, a typical IRA account, anybody can invest in a typical IRA, traditional IRA account. The question is it tax deductible or not? A person who makes $200,000, it's not going to be tax deductible. A person who makes $40,000 a year, it will be tax deductible. So that's the traditional IRA. A Roth IRA cannot be made, the contribution for a Roth IRA cannot be made for a person who makes $200,000. The government has restricted or limited the people based on their income that can contribute to a Roth IRA. And let's say that it's somewhere in the neighborhood of $130,000 to $150,000. Above that, you can't do can't make a contribution to a Roth IRA. But a Roth IRA is very attractive in that once you make that investment, all of the growth, let's say that it grows over 20 or 30 years, over that long period of time, when you eventually take not only the principal, but the growth out of a Roth IRA, it's not taxable based on the way the laws are right now. Very attractive. Whereas a traditional IRA, when you take money out of a traditional IRA or a rollover IRA, all of the money that you take out of a traditional IRA will be taxed at whatever your tax rate is.
It's right. When you take it out.
Right, exactly. So the question is, if a person's making a lot of money and they want to make a contribution to a Roth IRA, here's a little nuance. How can they do that? Well, there's a little loophole in the laws. If a person is making $200,000, let's say, or $175,000, whatever the number is, and they want to get money into a Roth, they can make a traditional IRA contribution and the next day do a Roth conversion. What does that mean? It means that you take any growth of that traditional IRA, you pay the tax on the growth, and if you have it invested for a day or two, it's not going to be much growth there. You convert it to a Roth, you pay the tax bill, and off you go with a Roth. It's something that we do for our clients. It's something that not everybody knows how to do, but it's a little legal way of getting a high-income earner to have a Roth IRA account. There's also a feature if a person has a traditional IRA sitting out there and they want to get into a Roth, anybody can make a conversion from an IRA account into a Roth IRA account. You're going to pay the taxes on the growth of the IRA, but anybody can do that. It's a little complicated, I know. If anybody has questions, please call my office. I'll be more than happy to walk you through.
A lot of this is very complicated because our tax laws are thousands of pages long, and the 401k actually is the number is based on the original paragraph within the law that it was created. It had no
401k, correct.
Was the paragraph and the subparagraph number within the law, and we have that on a lot of government numbers and things. Just want to remind everybody, the trivia question tonight is, when did Congress approve the Roth IRA? Please give us a call. Give you the gift certificate to the Fleet Street Kitchen, 410-481-1300. I know there are a number of things we talked about trying to do on the show. One of the other things you mention and talk about, which I don't know if a lot of people take care of, is it was after my time with my kids. The 529 accounts. Can you explain that a little bit? Because that's a vehicle, as I understand it, for education.
Sure. A 529 is essentially an educational account that you can set up for your child or grandchildren, where you put a set amount of money away into an investment, typically a mutual fund, and the growth of that 529 account, if in fact it's used for higher education, and there's lots of rules around that, stipulations, but let's just say for college expenses, things of that nature, the growth amount that is derived from a 529 is tax-free to the family who is paying for the, or the owner of the account is paying for the college education for the child. One thing I might add is I send all of my clients now to T. Rowe Price for a 529 account. Why do I do that? Number one, T. Rowe Price, great firm. Number two, they run the 529 program for the state of Maryland. And if you invest in a 529 program with T. Rowe Price, you get a small tax deduction for doing that on your Maryland state taxes. So it's worthwhile to do it, and we send all of our clients over there. But it's a great way, especially for families that have younger children, and I might say who also have generous grandparents. If the grandparents want to open up a 529, put money into it for the child, pardon me, and let that grow over the years, it should turn out to be a helpful amount of money for educating the grandchildren.
I think they didn't have it. I don't think when I was. My kids are too old for doing that. Fortunately, their grandparents helped set up educational trusts a little differently to help them with their college education, which was wonderful. But that's something that I would recommend any family is once you have a child, is set something up. The longer the investment and the longer the contribution, the more total return you'll have.
Along those lines, can I mention one other thing?
Go ahead, please do.
Many people have IRA accounts. And I believe at the end of last year, there was a law that was made permanent. And that is if a person has an IRA account and they have to take a minimum or a required minimum distribution, RMD, out of the account today, if you want to give that distribution to a charity, not only will it count towards the money that you have to take out of that IRA account each year, but it is also tax-free because you're giving it to a charity. So for those of you out there that haven't done your RMDs for the year yet and have different charities that you'd like to give that money to, remember that you can give it directly from your IRA account. The check needs to go from the institution that's holding the IRA account right to that charitable organization. It's not taxed, and it counts towards your RMD.
Well, the other thing is, which having been involved in fundraising and for a number of nonprofits or social enterprises myself, that is also a vehicle to use for estate planning for charitable giving. Because particularly from a traditional IRA or 401k, because when you take a when you pass away, that money gets highly taxed, both personal income and estate taxes, where if you give it to a charity, it's tax-free. It's not taxable. Instead of using your own money, use the retirement account, and it is a substantial investment bonus for you, because otherwise you have to pay double taxation from a traditional IRA, something that I've used in discussion helping raise capital funds for nonprofits.
Good point to bring up, in that we work with our clients not only in managing the investments and putting together pretty sound retirement plans, but we also work with the attorneys on the estate planning side to get through the issues that you just described.
Absolutely.
To make sure that as much money as possible gets transferred to the heirs, but taxation is minimized as well.
Absolutely. And that's where you said you work together with the attorneys, the accountants, in helping all of that planning, and you need that team. Sorry, no one called in for the trivia question. Congress approved the Roth IRA, in 1997 when they passed the Taxpayer Relief Act. And for those who want to know, the original IRA was approved in 1974.
Well, Allan, since you know the answers, I would love to take you to dinner to that place you just mentioned.
That's another story. I appreciate that. We can talk about that off air. I do want to thank you, Troy, for being here very much. I appreciate it.
My pleasure, Allan.
If the listeners listening here would like to reach you, how can they reach you?
Well, you can either Google Troy Brewer, and no, I'm not the minister, and no, I'm not the basketball star, but I'm the FA or the financial advisor in Lutherville, Maryland. So that's the one that you want to click on. Or you can you can Google the Brewer Investment Group of Wells Fargo Advisors. That'll bring you into my website. Contact information is there. If we can help in any way, please give us a call. My telephone number, 410-494-6815. I'd love to talk to you.
Well, thanks again for being here. I also want to thank my producer, Nathan, who makes the show happen. Larry Wilner of LW BizFlix for videotaping the show. Please join me next Tuesday at 6 p.m. when my guest will be Secretary Jimmy Ray, who's at the Governor's Office of Minority Affairs. I'm Allan Hirsh of Allan Hirsh Advisors, your host. To reach me, call me at 443-977-4500. This has been AHA Business Radio on CBS Sports Radio, 1300 AM.